when Janet Yellen says to Russia, if you do 1 penny, we're going to confiscate it, but we can give billions. The hypocrisy is making the world say, screw it. They're an insolvent country, us. We are inflating away the dollar. We are destroying the value of the bond market. We are wholly hypocritical in terms of the way that we view the world and make rules. They're looking to gold and commodities, as Zoltan Pozsar says, as assets that have no counterparty risk, instead of debt, opaque opaque debt promises, which have a very small historical footprint in terms of being an asset from a country that can steal it from you. I wish I wasn't so pessimistic, but I really, Ben, I think there's a fine line, man, between pessimism and realism these days. And this is not lost on the rest of the world. And I think people need to understand that things are changing as a result of the actions of our leaders who just seem to be doing all of the wrong things. You know, I'm giving a speech too down here in Boca in a month at Rick Rule's conference. And the title of my first speech, I wanted it to say, is it too stupid to be stupid? My wife thought that was a little harsh, so I'm changing it to something like, is it too ridiculous to not be planned? And I think in many respects, it just seems to be too stupid to not be planned. I think that there are two choices, typically. That's what people would say. There are two choices. You know, look, let's quantify things first. We're a country that has nearly a $35 trillion debt. A trillion seconds ago was 31,688 years ago. I just read something and I wrote it down here because it kind of struck me. And about how big this number really is. I mean, 31,688 years ago is pretty big in a trillion seconds, but the debt at $34.7 trillion, if you laid dollar bills, how thin is a dollar bill? If you laid them end to end, it would wrap around the earth 134,599 times. That's enough to travel to the sun and back 17 times. That's just the 34.7 trillion. But we have unfunded liabilities, all owed to the American people, by the way, which kind of fits into my ideology, my theme, and that is Medicare, Medicaid. Medicare Part B is $99 trillion underfunded, 99 trillion. Medicare Part D, the prescription, 22 trillion. Social Security, 77 trillion. Government military pensions, all owed to us, works out to 160 or 170 trillion dollars, or 200 trillion in debt, right? The numbers are too big to ever be paid back. But I find it interesting that the majority of the debt is owed to us because as China and Japan and Russia and Saudi Arabia and all of these countries are shedding U.S. treasuries, who's been buying them? In large part, it's us. The hedge funds, the money markets, the mutual funds, the people chasing yield have been buying the treasuries as central banks have been selling and buying gold and commodities. And you can look at a graph of the Chinese acquisition of gold versus their divestment of treasuries, and it's like this. And this is the rest of the world. They're selling treasuries and buying gold because not only has gold outperformed the treasury market, it has no counterparty liability. It can't be sanctioned or confiscated from a foreign nation the way that treasuries have. We've proven treasuries can if we do not align ideologically. Well, we're going to take it from you, let alone inflate it away. And so when you look at a debt burden the way that we have, my mentor, Richard Russell, God bless his soul, used to say 15, 20 years ago, the Fed, when we only had a $15 to $17 trillion debt, that the Fed was trapped and they had two choices, inflate or default, inflate or die, he always used to say. And I would say that there's a third choice, and that is to find a villain, and that is Xi Jinping and OPEC and Putin, to incentivize the world to move away from the dollar by allowing these countries to unite under the BRICS flag, by pushing OPEC away, by signing executive order to go green.
Andy Schectman delves deeper into the implications of the U.S.'s massive debt and unfunded liabilities, highlighting the precariousness of the current economic situation. He argues that the U.S. is facing an insurmountable financial burden, with a debt so large that it is beyond the scope of repayment. The national debt, currently at $34.7 trillion, and unfunded liabilities totaling around $160 to $170 trillion, present a daunting picture of financial mismanagement and future instability. Schectman uses stark imagery to illustrate the scale of the debt. He explains that if dollar bills were laid end to end, the national debt would wrap around the earth over 134,000 times and stretch to the sun, and back 17 times. These comparisons serve to underscore the enormity of the financial challenge facing the U.S. and highlight the impracticality of ever repaying such a colossal debt. As foreign nations shed U.S. treasuries, the domestic financial sector has been absorbing these assets. Hedge funds, money markets, mutual funds, and other institutions have been purchasing treasuries in large quantities, chasing yield in an environment where central banks are moving away from U.S. debt. This shift indicates a significant loss of confidence in the U.S. dollar as a safe store of value. Instead, central banks are increasing their holdings of gold and other commodities, which do not carry the same counterparty risks as fiat currencies. Schectman points out that this trend is not limited to a few countries, but is a widespread phenomenon. Nations like China and Russia are leading the charge, protect their wealth from the instability and geopolitical risks associated with holding U.S. dollars. Gold, with its intrinsic value and lack of counterparty risk, offers a more secure alternative. Schectman also discusses the broader geopolitical implications of these financial shifts. He argues that the U.S. government's actions, such as imposing sanctions and threatening asset confiscation, are eroding trust in the U.S. financial system. These actions send a clear message to other countries that their assets are not safe if they do not align ideologically with the U.S. This has led to a significant reevaluation of asset safety, with countries preferring gold and other commodities that cannot be as easily manipulated or confiscated. The move towards gold is not just about protecting wealth, but also about asserting financial independence. As countries accumulate gold, they are reducing their reliance on the U.S. dollar and the global financial system dominated by the U.S. This trend is particularly evident among members of the BRICS nations, Brazil, Russia, India, China, and South Africa, which are increasingly trading among themselves in their local currencies and accumulating gold as a reserve asset. Schectman also highlights the historical context of these shifts. He explains that gold has always been a fundamental store of value throughout history, particularly in times of economic turmoil and uncertainty. The current global financial landscape, marked by high debt levels and geopolitical tensions, is prompting a return to this age-old safe haven. Gold's ability to maintain its value and its universal acceptance as a store of wealth make it an ideal asset in uncertain times. In addition to central banks, private investors are also turning to gold. The growing demand for gold among individual investors reflects a broader distrust in the financial system and a desire for security. Schectman notes that gold has consistently outperformed other asset classes in recent years, further solidifying its status as a reliable store of value. Schectman is critical of the mainstream media's failure to adequately cover these important financial trends. He argues that the media does a poor job of informing the public about the realities of the global financial system and the growing shift towards gold and commodities. This lack of coverage leaves many people unaware of the significant changes taking place and the potential implications for their own financial security. Andy Schectman provides a comprehensive analysis of the current financial landscape, highlighting the unsustainable nature of the U.S. debt and the growing shift towards gold and commodities. He argues that the actions of the U.S. government, coupled with the massive debt burden, are driving other nations and private investors to seek safer alternatives. Gold, with its intrinsic value and lack of counterparty risk, emerges as a preferred choice in this environment. Schectman's insights underscore the importance of understanding these trends and the need for individuals and nations to reassess their financial strategies in light of the changing global landscape.
And it aligns with Jared Bernstein's ideological views. You know, Jared Bernstein, I'm sure many people have seen this guy's ridiculous interview that they were showing snippets of it on Twitter, where he was trying to explain how the bond market works, how the Treasury sells bonds, how the government prints money. It was the most humiliating thing I've ever seen come out of the mouth of the lead economic advisor of the U.S. government. But if you go back and research him and title Jared Bernstein in the search bar, Dethrone King Dollar, you'll find a report that he wrote. It was picked up by the New York Times, or statements he made to the Washington Post when Trump threw tariffs on China, asking or saying, good, maybe we'll lose the reserve status. His whole thesis is to lose the reserve status. It's a privilege we can no longer afford. So you have an executive order to go green when the linchpin of the dollar hegemony is our relationship with OPEC and Saudi Arabia. For them to, for protection, they will value oil in dollars and recycle the excess in treasuries. Well, they are no longer selling oil just in dollars. You see these mutual deals or these deals in local currencies amongst countries where example, Saudi Arabia sells oil to China for yuan and it is immediately convertible into gold on the Shanghai Gold Exchange. So, gold is now replacing the treasury bond, in my opinion, because it has no counterparty risk and has massively outperformed the bond market in the last since beginning of the century. And the settlement outside of dollars chips away at the dollar hegemony, and the excess reserves not going into treasuries, in fact, being sold, going into gold, chips away at the reserve status. But why do it is a good question. Well, like I said, 200 trillion in debt. How do you ever pay it off? Well, you inflate, you default, or you find a villain. Those bastards did it to us. They dumped the dollar. How could they do it? And how many people know that gold is tier one? How many people know that Saudi Arabia signed a protection agreement with Russia, or that they've applied to the Shanghai Cooperation Organization, or joined the BRICS, or all of these things? How many people know it? Nobody. How many people know that it's the backing of the Saudi kingdom that gives the dollar its reserve status? Hardly anybody. The media doesn't just do a bad job, they do no job of telling us what's coming. So for them to point to this as a villainous act would work. And at the same time, who's all the debt owed to? Medicare, Medicaid, Social Security, government, military pensions. That's us. How about all the treasuries? Who's been selling them? Them. Japan, China, Saudi Arabia, Russia, all of the countries are shedding treasuries because not only has the treasury market been horribly performing over the last year and a half as they raised rates 500 basis points in a very quick period of time after a decade-long plus of zero-bound federal funds rate, destroying the value of all those bonds in circulation that they hold, the 10-year treasury. But they can be confiscated now if we don't agree with you. Doesn't matter that, when Janet Yellen says to Russia, if you do 1 penny, we're going to confiscate it, but we can give billions. The hypocrisy is making the world say, screw it. They're an insolvent country, us. We are inflating away the dollar. We are destroying the value of the bond market. We are wholly hypocritical in terms of the way that we view the world and make rules. They're looking to gold and commodities, as Zoltan Pozsar says, as assets that have no counterparty risk, instead of opaque debt promises, which have a very small historical footprint in terms of being an asset from a country that can steal it from you.
Andy Schectman's discourse reaches a crescendo as he elaborates on the broader geopolitical and economic consequences of the U.S.'s current financial trajectory. He argues that the United States, by leveraging its economic policies and sanctions, is inadvertently pushing the world towards a new financial paradigm centered around gold and commodities. Schectman underscores the critical point that gold and commodities are increasingly viewed as safe havens due to their lack of counterparty risk. Unlike fiat currencies and debt instruments, which are promises to pay and thus inherently carry the risk of default, gold is a tangible asset that holds intrinsic value. This fundamental difference is driving countries to shift their reserves from U.S. treasuries to gold. The move away from the U.S. dollar is particularly evident in the actions of major global players like China and Russia. These nations are systematically reducing their holdings of U.S. treasuries and increasing their gold reserves. This strategic shift is not just a financial maneuver, but also a geopolitical one, reflecting a desire to diminish dependency on the U.S. financial system and protect their wealth from potential sanctions or financial repression. Schectman also touches upon the broader implications for the global financial system. The decreasing demand for U.S. treasuries as countries diversify into gold and other commodities poses a significant challenge for the U.S. The reduced demand for treasuries could lead to higher interest rates and increased borrowing costs for the U.S. government, exacerbating the already precarious debt situation. The shift towards gold is also part of a broader trend of de-dollarization, where countries seek to reduce their reliance on the U.S. dollar for international trade and reserves. This trend is driven by several factors, including the desire to mitigate the risks associated with U.S. monetary policy and the strategic goal of reducing economic vulnerability to U.S. sanctions. Schectman highlights the role of the BRICS nations in this de-dollarization trend. These countries are not only accumulating gold, but are also increasingly conducting trade in their local currencies. This move challenges the US dollar's dominance in global trade and finance, signaling a potential shift towards a more multipolar financial system. The implications of these shifts are profound. If the trend of de-dollarization continues, it could lead to a significant realignment of global economic power. Countries that successfully diversify their reserves and reduce their reliance on the US dollar will be better positioned to withstand economic shocks and geopolitical pressures. Conversely, the US could face significant economic challenges as it loses the exorbitant privilege associated with being the world's primary reserve currency issuer. Schectman also discusses the impact of these trends on individual investors. He emphasizes the importance of understanding these global shifts and adjusting investment strategies accordingly. As confidence in fiat currencies and debt instruments wanes, investors are increasingly turning to gold and other tangible assets to protect their wealth. This growing demand for gold among private investors reflects a broader recognition of the risks associated with the current financial system and a desire for more secure stores of value. In addition to gold, Schectman points out that other commodities are also gaining traction as investment assets. Commodities like silver, copper, and oil are essential for various industries and are likely to see increased demand as the global economy evolves. These assets, like gold, offer intrinsic value and can serve as effective hedges against inflation and currency devaluation. Schectman is critical of the lack of public awareness and understanding of these important trends. He argues that mainstream financial education and media coverage often fail to adequately explain the implications of these global shifts. This lack of information leaves many investors unprepared for the potential changes in the financial landscape. In conclusion, Andy Schectman provides a thorough and insightful analysis of the current state of the global financial system. He argues that the US's financial policies and the massive debt burden are driving a global shift towards gold and commodities. This trend, he asserts, is a strategic move by countries and investors to protect their wealth from the risks associated with fiat currencies and debt instruments. Schectman's insights highlight the importance of understanding these global shifts and the need for both nations and individuals to reassess their financial strategies. As the world moves towards a more diversified and multipolar financial system, gold and other commodities are likely to play an increasingly central role in global finance.